Bill Ackman is no stranger to bold bets. As the mastermind behind Pershing Square Capital, his portfolio decisions often make headlines. So what moves did he make in the past quarter? With an almost 13 billion portfolio spread across just 10 holdings, Ackman's strategy is as focused as it is fascinating. In this video, we will review his portfolio, provide a brief overview of each of his holdings, and discuss the valuable lessons that can be learned from his approach. This is my third video in the Super Investor Portfolio series, so if you haven't yet, consider subscribing to not miss out on future Super Investor Portfolio updates. But before we dive into the specifics of Ackman's portfolio, it's worth understanding the man behind these strategic decisions. Bill Ackman is one of the most recognized names in the world of investing. As the founder and CEO of Pershing Square Capital Management, Ackman has built a reputation for making bold, high-conviction bets, and these bets often pay off handsomely. His fund consistently delivers outstanding performance. Over the 5-year period ending in February 2024, Ackman achieved a total return of 212%, easily outperforming the S&P 500's 99% increase over the same time frame. This remarkable track record makes him a compelling case study for aspiring investors. Ackman's concentrated approach means every holding is carefully chosen, representing his belief in its long-term potential. His impressive performance demonstrates the value of following his moves, not just to mimic them, but to learn from his disciplined research and investment philosophy. With this context, let's explore Ackman's latest portfolio and what these high-conviction investments tell us about his outlook on the market. With a concentrated portfolio worth almost 13 billion across just 10 holdings, each position tells a story of focused investment. Ackman's smallest position is a higher risk play in Seaport Entertainment. With less than 0.5% invested, this investment reflects Ackman's interest in the niche entertainment and leisure sector. Canadian Pacific Kansas City Limited takes up almost 10% of Ackman's portfolio. This North American railway operator remains a steady performer, benefiting from cross-border logistics demand. Over 11% of Ackman's portfolio is in Nike. Ackman made a significant move into Nike this quarter, likely drawn by its unparalleled brand power and global presence in the athletic apparel market. Additionally, just above 11% of his portfolio is invested in Howard Hughes Holdings. This real estate developer focuses on master planned communities, aligning with Ackman's interest in long-term urban growth trends. Restaurant Brands International takes up almost 13% of Ackman's portfolio. As the parent company of Burger King, Tim Hortons, and Popeyes, QSR reflects Ackman's bet on global fast food dominance. A similar bet, also taking up almost 13% of his portfolio, is in Chipotle Mexican Grill. Chipotle's consistent innovation and strong digital presence keeps it at the forefront of the fast casual dining industry. His third largest position, taking up a bit over 13% of his portfolio, is in Hilton Worldwide Holdings. A longtime favorite, Hilton continues to represent Ackman's belief in the recovery of the growth of the travel and hospitality sector. His second largest holding, taking up around 13.5%, is in Brookfield Corporation. Ackman increased his position significantly in this global asset management company, which specializes in real estate, infrastructure, and private equity. Finally, Ackman's largest stake of his portfolio is in Alphabet, more commonly known as Google. With almost 15% of his portfolio split between the two different classes of stock, this investment highlights his belief in the long-term growth of its search advertising, and cloud businesses. This portfolio demonstrates Ackman's strategic balance of growth, stability, and willingness to make bold moves in industries he believes in. With significant changes like increased positions in Brookfield and Nike, it's clear Ackman is as deliberate as ever in his investment strategy. Now, let's do a quick overview of each of his holdings. Seaport Entertainment Group represents almost 0.5% of Pershing Square's portfolio. SEG specializes in niche entertainment, targeting a less saturated market compared to traditional players. Also, the company ended their last quarter with $23.7 million in cash and cash equivalents, which gives them a strong cash position and enhances their liquidity. SEG completed a rights offering, generating $175 million in gross proceeds to boost its liquidity. When it comes to cons, an almost 2% decrease in revenues year over year indicates potential challenges in core business areas. Additionally, leisure spending often declines during recessions, which could pressure their revenue. Finally, the company reported a 7.9% decrease in profitability over the last quarter, which could limit their growth. Canadian Pacific Kansas City accounts for 9.8% of Ackman's portfolio. The Kansas City Southern acquisition has expanded CP's reach, creating the only railway connecting all three North American countries. Additionally, in the last quarter, their revenue increased by 6% year over year, driven by higher freight volume and improved pricing. Another pro is the fact that the company's operating ratio improved, reflecting efficient operations. However, in my opinion, they benefit the most from the fact that rail transportation remains essential for industries like agriculture, energy, and manufacturing. When it comes to cons, their merger could face additional scrutiny from regulators, especially regarding competitive concerns. Also, maintaining and expanding railway infrastructure requires significant ongoing investments, which could impact profitability. Furthermore, economic slowdowns or geopolitical tensions impacting cross-border trade could reduce freight volume. Finally, the railway industry frequently faces union-related challenges, potentially disrupting operations. Ackman added over 400% to his Nike position, which currently accounts for over 11% of Pershing Square's portfolio. When it comes to pros, Nike's global brand recognition is unmatched, making it a leader in the sportswear industry. Additionally, Nike's shift to digital sales has helped the company drive strong online revenue growth, especially in the Q3 of 2024. Also, Nike continues to expand in key international markets, especially in Asia and Latin America, bolstering long-term growth prospects. Finally, the recent drop in the stock price shows that the company might be overlooked. For cons, global supply chain challenges and rising raw material costs could disrupt production and affect profitability. Additionally, Nike's premium pricing strategy may limit its appeal in price-sensitive markets, especially during economic downturns. Finally, Nike has faced labor rights challenges in the past, especially related to overseas manufacturing, which could hurt its brand image. Howard Hughes Holdings makes up a bit over 11% of Pershing Square's portfolio. The company has several large-scale projects under development, providing long-term growth opportunities in the real estate sector. Also, the company has seen a consistent increase in revenue, driven by both residential and commercial properties. Finally, Howard Hughes has access to substantial capital and strong liquidity, which supports its ongoing development projects. When it comes to cons, As a real estate developer, Howard Hughes is highly exposed to volatility of the real estate market, including potential downturns. Additionally, large-scale development projects carry significant risks, including cost overruns and delays, which could affect profitability. Also, the demand for real estate, especially in luxury segments, is highly dependent on overall economic growth and consumer spending power. Finally, if the Fed would decide to increase interest rates, it could easily slow down the demand for real estate, especially in the residential market, impacting the company's revenue and profitability. Restaurant Brands International represents almost 13% of Ackman's portfolio. The company owns such fast food giants as Burger King, Tim Hortons, and Popeyes, each of them having a strong global presence. Additionally, QSR reported 2.5% same-store sales growth over the last quarter, which is crucial for such businesses and reflects strong consumer demand and effective marketing strategies. Also, the company's franchise model provides a steady stream of recurring revenue and limits capital expenditures. Finally, Restaurant Brands continues to expand internationally, especially in high-growth markets like China and India, driving long-term growth potential. When it comes to cons, while the franchise model provides stability, it also limits control over operations, leading to potential brand consistency issues. Also, rising food and labor costs could hurt profitability and erode margins, especially in a highly competitive industry. Finally, changes in consumer preferences, such as shifts towards healthier eating, could impact sales and traditional fast food chains. Chipotle Mexican Grill accounts for almost 13% of Ackman's portfolio. In the case of Chipotle, Ackman's Pershing Square Capital Management took a significant stake in the company and then pushed for changes in leadership, operational strategies, and corporate governance. Ackman's involvement wasn't just about collecting dividends or waiting for the stock price to rise. He actively worked with the company's management to implement changes that improved their performance, especially in the issues like food safety scares that had impacted the brand's reputation. When it comes to pros, Chipotle continues to report robust same-store sales growth, reflecting strong consumer demand for its fast casual offerings. Also, the company's focus on fresh, customizable food options has helped build a loyal customer base. Finally, Chipotle is aggressively expanding its footprint, aiming to open 200 new locations annually for the next few years. When it comes to cons, rising food and labor costs have put pressure on margins, and it may become difficult to pass on these increases to consumers. Additionally, Chipotle relies on fresh ingredients, which exposes it to supply chain disruptions, especially in uncertain times. Finally, the fast casual dining segment is highly competitive, with many new entrants competing for market share. Ackman reduced his share in Hilton worldwide holdings by almost 18%. However, it still represents around 13% of Ackman's portfolio. Hilton operates a vast network of well-known brands, including Hilton, Waldorf Astoria, and Conrad, which allows them to cater to various customer segments. Also, Hilton's international footprint continues to expand, especially in emerging markets, driving strong revenue growth. Additionally, increased travel and high occupancy rates following the pandemic recovery boosted Hilton's revenue. Finally, and this is what I like the most, Hilton continues to report high margins, with last quarter operating profit increase of 11% year-over-year. For cons, labor shortages and inflation have increased operational costs for the company, which could pressure margins. Also, hotel demand is highly sensitive to economic downturns. with common declines in travel spending during recessions. As a global brand, Hilton is vulnerable to fluctuations of foreign exchange rates, which could affect earnings from international operations. Ackman added almost 400% to his Brookfield Corp position, which became his second largest holding and now represents almost 13.5% of his portfolio. Brookfield's broad range of investments across real estate, infrastructure, renewable energy, and private equity provides stability and growth. Their total assets under management exceed $750 billion, allowing it to generate consistent cash flows and achieve strategic growth. Also, the company has a proven track record in managing and optimizing real estate and infrastructure assets globally. Finally, Brookfield is heavily invested in renewable energy and sustainable projects, positioning it well for long-term growth amid the global shift to cleaner energy. For cons, Brookfield's large exposure to real estate and infrastructure markets makes it vulnerable to economic downturns and shifts in interest rates. Also, the company uses a significant amount of debt to fund its operations, which could be problematic if the interest rates start to rise. Also, Brookfield's global operations expose it to geopolitical risks, especially in emerging markets where the regulatory environment can be unpredictable. Finally, the company's large-scale infrastructure projects require heavy capital investments, which may limit flexibility and growth in certain sectors. The combined different class investment into Alphabet makes Google the biggest holding in Ackman's portfolio, with almost 15% of his portfolio. Alphabet continues to show strong revenue growth. In its latest quarter, the company showed 15% revenue growth year over year. Alphabet has a well-diversified portfolio. The company's investments in AI, cloud computing, and YouTube provide multiple growth avenues. Additionally, they have been showing strong cash flow, which enables them to continue investments and innovate. Finally, Google is a moat. It maintains a dominant position in search and online advertising, contributing significantly to Alphabet's revenue. When it comes to cons, Alphabet faces increasing regulatory challenges related to antitrust concerns, data privacy, and market dominance. Also, despite diversification efforts, a large portion of Alphabet's revenue still comes from advertising, making it vulnerable to ad market downturns. Additionally, competitors like Microsoft, Amazon pose significant threats in the cloud and AI markets. Finally, digital ad spending often declines during economic slowdowns, which could impact Alphabet's short-term revenue. So, Ackman's portfolio offers valuable lessons for value investors, focusing on conviction, long-term growth, and competitive advantages. Ackman's portfolio is concentrated with just 10 holdings. This highlights the importance of deep research and conviction in your investments rather than spending yourself too thin. It basically tells us to invest in companies you thoroughly understand and have high confidence in, rather than diversifying too broadly. Many of Ackman's top positions like Chipotle, Canadian Pacific, and Google benefit from strong competitive advantages, allowing them to maintain market leadership, which teaches us to prioritize companies with long-lasting competitive moats that can weather economic downturns and deliver consistent returns. Ackman's focus on long-term value creation, as seen with Brookfield Corp, shows that value investors should look beyond short-term volatility and focus on sustained growth, basically teaching us to focus on the long-term potential of companies, not short-term market movements. Ackman's activist approach, such as in Chipotle, demonstrates how investors can influence companies to unlock value through operational improvements, which teaches us not to hesitate to get involved in companies where you see opportunities to create value. Although Ackman's portfolio is concentrated, it spans across multiple sectors, reducing risks tied to any single industry, teaching us to diversify across industries, not just individual stocks, to balance risk and maximize returns. In conclusion, Ackman's portfolio teaches value investors the power of focused investing, strong competitive advantages, and long-term thinking. By carefully selecting high-conviction stocks and looking for companies with sustainable growth potential, investors can apply these principles to achieve long-term success. But what do you think about Ackman's portfolio? Do you agree with his approach? Comment with your thoughts down below. And as always, guys, if you enjoyed the video, consider subscribing and hitting the like button. Thank you for watching, and I hope to see you in the next one. Bye.